Happy Monday, everyone. Welcome back to Your Finance TV to look at the week ahead in markets. We investigate what could be the next sector in trouble after the collapse of Credit Suisse over the weekend and concerns for regional banks in the US. What will the Fed interest rate decision be? Is the correlation between Tesla and Bitcoin over? And what is up with energy prices? And of course, we wrap it up with love it, like it, leave it picks. Who better to take us through these burning questions but Brendan McCarty, founder of Column E. How are you, Brendan?
I'm great. Warming up after a cold weekend. How you doing?
Fantastic. I'm really good. Thank you. Before we kick off, don't forget to click on the subscribe button and the like buttons below. We have plenty of great content coming your way, so make sure you can stay in tune with that. All right. Regional banks are in trouble, with nearly 200 additional local and regional banks vulnerable to the same type of risk that Silicon Valley and Signature Bank faced. There's been a confidence hit in European banks on the back of Credit Suisse's collapse. So what sector is also vulnerable that people haven't been talking about? I'm thinking about the insurance space, Brendan. Take a look at this chart. We've seen a pullback in the sector, but with more fears in the banking space, could we see more downside here?
It's kind of an interesting sector. Like the BKX and the financials are weighing on all the majors. We're updating our thing called rundown this morning, and I'm already going through the charts. And 3 of the 4 indexes are pointing down only because they have so much financial exposure. And the NASDAQ's the one pointing out because it doesn't have as much. The insurance is, when you think of the financial wave that's sweeping through the markets, you wonder if it's like a tidal wave that's just knocking down pillar after pillar, and insurance seems to be one of them. Insurance is like a black box of sorts of investments. They have to meet whatever, like payout. Like it's all about payouts and insurance and annuities. And they have to, they sell it like a 5% annuity or 6% annuity, or an insurance sells a policy at X and they have to make certain amounts in death benefits. Insurance has fallen aggressively, but less so than the BKX. So if you were just to look at the two of them compared, it's fallen less, and it's fallen right to support from the last dip, which I don't have the chart up in front of me. But I think what people are trying to figure out with insurance is, like, what's their exposure to private equity? That's been a bad year for private equity's had a terrible year. What's their exposure to real estate? Another investment, long-term, spits out income to cover an insurance. What's the exposure there? Well, CRE's in bad shape right now. I mean, you go into the city of Boston and the occupancy rate is just falling further. Well, that's commercial real estate. They can turn it to condos all they want. It's not commercial real estate anymore if it goes to become a condo. So I think what you're seeing in the short term is the insurance is falling into some sort of support, and then it becomes the show me sector. Where's the weakness? Is private equity going to take it down? Because private equity is in a lot of pain. And that's where they all proliferate. There was a study out of the Fed that said that insurance companies were moving into private equity and alternatives because that's where the yield was. Well, now we're looking at 5% interest rates in the T-bills, which is a pretty good rate for them to, hang their hat on. But how much cash do they have available to take advantage of it? So I think insurance is at support right now, I would say. But I think if we peel it back, and this financial problems continue to become a problem, continue to worsen, which it appears they are. Like the CS bailout this weekend was just a joke. I mean, bailout the way they did. This sort of thing impacts the system in different ways. And preferred stocks is the big thing this morning. Like the ATI, I still don't really know what ATI bonds are, but CS was loaded with them. Preferred stocks tend to track ATIs, and insurance companies love preferred stocks. So if the preferred markets start to have a problem here in the United States, it looks like they could correct this morning based on this analysis of some random guy on Twitter. Whether I don't know if it's true, I don't know if it holds. But if preferreds are that weak, well, that's going to impact insurance. I know insurance does go into preferreds because they pay higher yields. That's where they want to be. So insurance is at support. It could, if it breaks that support, it might join the rest of the banks. And then we start looking at who's holding CDS on the reclaims. And we start getting into the big arguments that plagued the sector in 08. I know a lot of people are saying it's not 08, it's not credit. But, interest rate risk is interest rate risk. And if it impacts your portfolio in a negative way and you have forced to sell bonds, it becomes a credit issue. So insurance is a sector to watch. It definitely is. It's right at support. I think whatever, like how the preferred market goes or how our credit goes from here is how we look at insurance going forward.
Yeah, I think for your comment on the pref shares, we've got to remember it's very different in Europe to the US. Now, ATIs were born on the back of the global financial crisis back in 2008. So they're probably looked upon by regulators over there as like a necessary evil at the time. Now, I'm not saying it's a good thing that what they've done, but in the US, I've got to imagine that it's like pref shareholders and so forth still have the priority in the event of bankruptcy / collapse of a bank. So I don't think there should be any pressure on the pref shares. So maybe that's just a automatic nervous reaction, but not necessarily a big problem for those pref shares.
There was a correlation there, though. The charts followed each other the last 3 years. It may have just been credit in general. Like, not diving into it. Like, pref shares, the problem with them half the time is liquidity, right? Like, you sit there and you're like, crap, there's no bid for these things because everybody else is spooked. Doesn't make them bad. I just remember I was in Fannie and Freddie when they collapsed, and we were trading in and out of those things. And Fannie and Freddie hadn't gone under yet. Like, there was talk about it, but this was in May before the '08 collapse, and Fannie, their preferreds dropped. They were yielding like 13 or 14% at the time, and it was like, all right, let's buy some more and trading it out of them. But this chart was maybe it was a sign of the times the last 3 years where credit just followed itself, and this is where there's like divergence. I don't know. I mean, preferreds, the banks here aren't going to. I mean, JP Morgan's not going to stop paying its preferred anytime soon. Neither is Bank of America. Any of these companies, like, they're so capitalized, it's crazy. And I don't know how many regional banks issue preferred stock. So
Yeah.
take it for what it's worth.
Now, Brendan, I know you're on the soccer fields on the weekend, but did you get a chance to see the cover of Barrons this weekend?
I stopped reading Barrons a long time ago.
Well, take a look at this. Buy the big banks was the headline on the front cover, which is a huge call considering that everything that is happening right now in the markets. Should we be concerned about the big banks? Of course, we all know that about the Forbes cover curse, which includes its most recent victim of Silicon Valley Bank. I know the different publications, so the curse rule probably doesn't apply. But isn't it too early to be making a call to buy the big banks?
So it's a mixed bag for me. They're getting they're getting assets coming onto their balance sheets. Problem with the big banks is when they get these assets, where the hell are they going to invest them? They're too big to start with. So if they go into certain markets, they tend to move them. Every time there's a stress event, money moves from the small to the big. I don't know. Remember the London whale in 19 with JP Morgan when he's moving cash markets over in the UK. Well, you know what that led to? It led to rates plummeting here, forcing the Fed to cut rates. Then the Fed had to fill the system with money to cover the repo issues. I don't know if making these bags bigger, can they capitalize on this? I mean, is it a port in the storm? Maybe. The BKX looks terrible right now. I don't think I'd buy anything banks based on the way the BKX looks. It's not. Today will be interesting because the Fed flooded the system with money last week. The numbers announced last week showed the Fed had really injected $300 billion. I know the whole world says this is not QE, but when our model climbs, it doesn't matter if it's QE or not. The banks tend to find support from this in general, but you got to take into account credit. So I would wait. The chart in the BKX just doesn't look the best in the world. I'd be a little wary of it. The regionals could be dragging them down. Like, I don't know, the inverse Kramer is saying sell JP Morgan because he was saying buy JP Morgan as I don't know what he called it, a beast or something. I don't know. It was making the rounds.
Yeah.
Yeah, so they all attacked him on it. But JP Morgan is a good bank. They know how to manage risk, but they're so large. How do they take advantage of the argument for the banks is they're going to get all the flows from the smaller banks, but they can't really equitize the cash that much. They're just so big. It's just one of those things. They're too big for the financial system, so they really can't take advantage of it unless they move large portions of money or take more risk with it, right? Is that what happens? I mean, that's largely what happens. So I would say with the banks, you back off and you stay away. I don't think I'd chase tech either. Tech has just screamed and the financials have shorted. So the hedge funds got into heavy short before this all started on the financials, and they're hitting pay dirt on it right now. They probably went long the small bigs and shorted the smalls and yada yada yada. But the conditions are set for the banks to do better. But when you're dealing with credit issues that you don't really know how they're going to play out, you sort of just need to be wary of it. There's always buying opportunities for the banks. If you don't buy it now, you'll have another opportunity to buy them. They always seem to go down. The BKX is actually back closing in on 2020 levels. So it's as if the banks have done nothing in the last 3 years. So I can see why they're saying buy the banks, but I don't know. The Fed had the rate curve is so mixed up in terms of the inversion with the twos is way below funds. If the Fed hikes rates this week, they're going to go they're going to go into real strict tightening mode right now. The system doesn't really need a strict tightening mode. So that's stressing the banks. So why would you buy the banks ahead of that? So I would be wary. Barrons, I never chased Barrons covers, that's why I don't read it. I love the opening take. I can't remember. I don't even know who writes it anymore, but I used to love it when whoever wrote it back then. I think he passed or something, but it was always a great read. But it was a great cynical view. But I would back off in the BK. The BKX is telling me to hold off, and the money is supportive of the BKX, but the BKX is not responding to it. So I think there's more work to be done in terms of stability here than anything.
Well, you talk about the rates there, and obviously the decision is on Wednesday. What's it going to be? Is it going to be 50, 25, nothing? Or Nomura's crazy forecast of a 25 basis point cut? Futures are saying it's a 75% chance of 25 bip hike and 25% chance of zero. Brendan, what do you think we're going to see?
So the Powell Fed has always followed the market. They give us tidbits. They tell us what's coming. Last night we started seeing pause, and the market didn't move on that. The market is firm on 25 basis points. To me, that says 25 basis points, and we'll move on. They'll dictate the language from there. If they were throwing out there pause, and then they pause with the market looking for 25 basis points, well, you know what? The market's going to have to adjust to that. They don't want volatility in equity, the bond markets. They want stability. Volatility in the bond markets right now is not what they're looking for. So it's funny how the markets are not budging on this. And Bloomberg is saying that the rate markets are all messed up. I think they're all confused. I think there's a lot of stories out there. Bottom line is, if they hike 25, they're going to get really tight. Really tight is not good when the 2 year is sinking the way it is. I'm guessing they're hoping that the 2 year is just responding to stress in the system. I think the rate 2 years actually saying that the Fed needs a cut, and that might be the next big thing that follows after this. But it's probably a 25 base point hike. That's what the market is saying, unless something changes in the next 48 hours, which doesn't look like it's happening. You'll be seeing 25 going up, in my opinion.
Do you think we see 25 afterwards as well?
I think it would be very dangerous for them to do that. The Fed always finds a way to screw things up. They've never done anything right. We're going to find out 6 months from now the Bank of Switzerland screwed up the Swiss CS UBS deal, because they never do anything right. It's just the way these banks are. They're driven by politics. Powell is a private equity guy, so I think he was a private equity guy before, right? I'm not mistaken. Carlisle, is that where he came from? I don't remember where he came from. But I don't think they're going up. The market, I don't think, is looking for another hike after this. I didn't actually look, but they were looking for like 3 hikes and then no drops until March of last year, about 4 weeks ago. I would say that if the Fed is smart, it won't hike again. It will respond to what the 2 year is doing. Gunlack, what's his name? I'm messing it up. Double line. What is his name? Anyway, he said that if the Fed doesn't hike rates on Wednesday, they're following the 2 year. And then he goes, what's the point of the central bank if they're just going to follow the 2 year? He's got a point. The Fed does tend to follow the 2 year. It does it on the lag. So if the 2 year remains below funds for a while, I don't think the Fed's hiking anytime soon after that. So I would say follow the 2 year. And based on that alone, I don't think they're hiking after this. I don't think they should. I think it'd be very stupid, actually.
Yeah. Listen, we're going to see a lot in between. my thinking on it always has been, no matter what happens now, Powell's going to be known as Mr. Transitory, right?
Yeah.
And if anything, he's going to overcook it rather than like just miss it and then do it like another 25, 12 months down the road. But we will see. There's so much data to come through in between now and then. Okay,
Well,
moving on to sorry.
I was going to say that the way he could play this, and I wrote about this, is he pauses now, they get this money out of the system that they just put in, push on the QT, and then start raising rates later if they need to once the curve normalizes. Respond to the curve. Don't push the curve. Respond to it. If you push the curve, you're going to damage your banks. Here we are. If you follow the curve, the banks can adjust. And that's what really matters more than anything. So anyway.
Well, be careful there, though, Brendan. That sounds like common sense.
Yeah. Like I said.
All right. Bitcoin, amazing week last week. Was held over, it's above 28,000 before we went on air. You've mentioned several times that Tesla seems to move with Bitcoin, Brendan, but last week was an exception. We did see other tech names rally, like names like Microsoft and Nvidia, which seem to like move in that tech space. Now, in the risk-off sort of scenario, you wouldn't expect Bitcoin to run like this. Now, is this move just an anomaly, or are you expecting that correlation to get back into rhythm?
I actually think this move by Bitcoin was getting it back into rhythm because Tesla bounced. Do you remember when was earnings? I don't remember, but Tesla faced that huge sell-off earlier this spring.
It was a few weeks ago.
Yeah, they faced that, and then they bounced aggressively. Bitcoin bounced the same time, but then stopped at 25K. Tesla stopped last week and a half ago, and has backed off. The two have almost come back together. If you look at it, if you do a 3-year look back at this, which is generally what we've been following, because Bitcoin hasn't existed for that long, so your chart stays short more than anything. But that gap was 8,000 points. Like, and I'm not saying that one should have bought Bitcoin based on this. I would have been more likely to say Tesla was going to fall to Bitcoin, that Bitcoin was going to rally to Tesla. But they've come back together and they're about to crisscross again. Crosses down haven't always translated to Bitcoin down, but the further Tesla pushes lower, Bitcoin eventually gives up. So long story short, this actually move by Bitcoin was equilibrium with Tesla based on this chart, which is kind of funny in that regard. I would have never thought that. I'm been amazed by the move myself. I didn't think we've been watching 25K, and the bounce off 20,000 was aggressive, and the chart, the candle was wonderful. Then it just smashed through 25K as if it wasn't there. It irritates me because the guy who runs MicroStrategy is probably like, "Woo, yeah, we're excited now," even though his company should be focused on business and not Bitcoin. I would just say Tesla and Bitcoin have almost fallen into equilibrium. So maybe Bitcoin may have run its course up here in the short term. I think it ran on lack of liquidity. I think this signature bank thing was a really big deal in terms of capital. Like it messed up. Signature Bank was a crypto bank, if I'm not mistaken. And the feds have been out crippling the crypto banks one after the other. They don't want them in the system. They don't want anybody involved with them. They've argued against them over and over and over again. The cynic in me says, the skeptic in me says Signature Bank went down because it was a crypto bank and not because of its exposure elsewhere. But, there's no proof to that. I'll just say that Tesla and Bitcoin have moved to equilibrium. I would think, the NASDAQ is a port and storm, like 2020. You bought Microsoft, you bought Apple, you bought the FANGs, and you rode them. It's the same playbook coming off the 2020 lows. Is this the same type of system? I don't think it is. So I would just say Tesla and Bitcoin have equilibrium. And so goes the NASDAQ, so goes Tesla for the short term, which by extension, maybe so goes Bitcoin. I don't know.
Lots of questions still there on that one. All right, let's look at energy. Remember when the government was going to buy oil at $70? Like, yeah, we're just going to buy back that inventory that they sold off. Someone may want to remind them that it's well under $70 now. Brendan, I want to look at the charts for oil and XLE, the Spider Energy ETF. and work out where does this sell-off potentially stop.
So 65.50 was a major support for us in the chart. We've been looking. It's one of the original levels that we've been following forever. I mean, I remember when we went from 46 to, was it 36 to 41 to 40. I don't remember levels back in the pandemic off the lows, but 65.50, 66 was a big level that contained the action. It was like sort of a midpoint between the lows and the highs that we saw over the last 20 years in a way. 65.50 is a good support for crude right now. It is below and above it all day today, so it's sort of jockeying around it. If anything, you're seeing more bearish arguments than anything than bullish. But I don't know if you've noticed that the pump prices have been going up quietly lately. I paid $3.40 a gallon over the weekend a couple times as I drive up and down 495 for soccer game after soccer game. But I would just say if gasoline is rallying this time of year, that is usually a support for crude. I know crack spreads have been very profitable. Like, people have been making a lot of money, selling gasoline more so than selling crude, relatively speaking. But now that the system's been flooded with dollars, and I like our SEM model jumped. Anytime the SEM model climbs, risk assets climb. So, and the dollar falls. So I think once we get through the stresses of the time, whether I don't know when that is going to be, if the dollar starts to meaningfully fall, that will support crude to go higher. Gold gave up this morning. It got over 2,000, I think, and fell backwards. So that argues that people are really not ready to jump in on a negative dollar trade just yet. But I think that will factor into crude. Also, we've talked many times about the consumer. Consumer is not dead in this economy. It is still spending. Those who have money have plenty of it and continue to spend. This might scare a few people as they have to move their money from bank to bank. But, the biggest thing, and I'm going off a little bit of a tangent here, but I'll say that people move money between banks really quickly these days. So as if it's nothing. So that is going to be a factor in terms of consumer spending, which affects crude and gasoline. Now, in terms of the XLE, it is sitting on support as well, the 65-week. It has held that every point since 2020. So I say if you're going to look at this sector and this crude, your biggest focus should be, will the XLE hold the 65-week after a major sell-off back to trend? And will crude hold the 65.50 level? If they hold them both, it might be an area where we start to see this thing start to resume its climb. And gasoline is a great leading indicator of crude prices. If gasoline is rallying at this time of year, it's always been a proxy for me. I used it when I was hedging. Gasoline was February to August, and heating oil was Sep to February. What did I say? Whatever. I fill in the gaps there. But I used it as a proxy in terms of hedging, and it always worked. And so, long story short, gasoline's moving, and that might be a leading indicator of energy starting to do better going forward.
Okay, let's move into like it, love it, leave it. We still have an earnings theme here, Brennan, believe it or not. There's still some big companies reporting. And we're going to kick it off with a good one. Nike, they report Tuesday after the close.
So I like it. It bounced off the 65-week, though. It ran to resistance at 122. So I need to get some momentum on that to climb over it. Side note, we were searching for Nike shoes yesterday. They're hard to find. So I don't know if that's a demand thing.
Okay. The second one we're looking at is Winnebago. WGO is the symbol. They report Tuesday after the close.
So I used to use a side note of this. We used to have a place up north, and I'd drive by a Winnebago place, and I could tell how the economy was doing by how many Winnebagos they were selling in the parking lot. So I don't know how it looks today. I would have loved to drove by it before looking at this, but the chart says leave it. Broke support around 60. Looks like it wants to go to the bottom of the range.
I actually think there might be Wednesday pre-market, so I'll have to go back to my notes on Winnebago, but WGO is definitely symbol. Now, Wednesday after the close is Chewy.
So I would leave it. It's kind of an interesting one. Broke support at 41 a few weeks ago. Looks like it wants to drop lower.
Next one is KB Homes, KBH, Wednesday after the close.
I can't believe I like this one based on the backdrop, but I like it. It regained 35. The home builders are showing some mysterious strength. Lennar was good last week. We didn't like it, but Anyway, KBA like it. KBH like it. Regained 35 barely. It's entering high range.
One we've looked at many times over the last couple of years, General Mills, GIS, Thursday pre-market.
Hated this one every time, but it continues to climb. This time I hate it again, or leave it. It failed at the 20 week. I think they're starting to see some stress in there, so I think I would leave it.
Okay, and the last one we're looking at is Darden restaurants, and every restaurant I go to is full. But at Thursday pre-market, they report.
So the chart says leave it. It looks a lot like Dick's does from a few weeks ago. We were leaving on Dick's. Dick's backed off from range and then exploded higher. Part of me, the chart says leave it. I wouldn't be surprised if they beat on earnings though, and they blew through the high. So it's something to be wary of. But I would leave it at this point.
All right. Well, Brendan, listen, thank you so much for this week. It's going to be a very interesting week. It's been an interesting few weeks leading up into this week. But with the Fed rate decision and these earnings and so many other things coming through, thank you so much for your insights.
Hey, thanks for having me as always.
And for everyone else out there, good luck investing.